Every time you look at a stock chart, you see those volume bars at the bottom, green and red, stacked neatly beneath the price action like a visual heartbeat of the market.
And you probably think you know what they mean.
Green means buyers are in control. Red means sellers are winning. It seems obvious. Intuitive. It has been taught in countless YouTube videos, trading courses, and even some broker platforms hint at this interpretation through their very design. There is just one problem. And this single misunderstanding might be costing you more than you realize. Let me explain. When you see a green volume bar, your brain processes a simple story. More people wanted to buy than sell. Demand was strong. This is bullish. When you see red, the opposite unfolds. Sellers dominated. Bears took control. Time to get defensive. This interpretation feels so intuitive that questioning it seems almost absurd. Green up good, red down bad. Buy the green, avoid the red. That simplicity is exactly what makes it dangerous. Here is the uncomfortable truth that nobody mentions in those colorful trading courses with their confident instructors and cherry-picked examples. Every single share that was bought was also sold. Read that again. If you bought 100 shares of Apple today, someone sold you those exact 100 shares. There was a buyer, there was a seller. The transaction occurred because both parties agreed on the price at that precise moment. This is not philosophy. This is not theory. This is how markets literally function at the mechanical level. The red bar? The price closed lower than it opened. The color has absolutely nothing to do with whether there were more buyers or sellers. It cannot, because for every single buyer, there is a seller, always, without exception. This is not sometimes true. It is definitionally true. So why does this myth persist with such stubborn resilience? Because it is comfortable. It creates a neat narrative that our pattern-seeking brains absolutely love. The market becomes a simple battlefield. Green team versus red team. Bulls versus bears. You just need to figure out which side is winning and join them. But trading based on this fantasy is like driving using a map that does not match the actual roads. You might arrive somewhere eventually. It just will not be where you intended. Let me show you how this plays out in the real world where money actually changes hands. Imagine a stock that has been climbing all day. Green candles stacking on top of each other. Green volume bars expanding beneath them. The chart looks healthy, strong. You think buyers are clearly in control, and you decide to join the party. But here is what might actually be happening beneath that pretty green surface. Those green volume bars could be filled with large institutional investors, quietly distributing their massive positions. They are selling into the strength. Retail traders are eagerly buying, providing exactly the liquidity these institutions need to exit without crashing the price. The volume is high, the price is rising, everything looks textbook bullish. The smart money is walking out the back door while you are rushing in through the front. The color told you nothing about this dynamic. It could not, because volume color does not measure intent. It does not measure who is accumulating and who is distributing. It does not reveal whether the big players are building positions or liquidating them. It just measures direction of price, and direction is the result of the last transaction, not the cause of future ones. This is where things get genuinely interesting. Professional traders and institutional algorithms do not waste processing power analyzing volume color. They look at volume context. Where is the volume appearing? Is it at support levels or resistance? Is it confirming a price move or diverging from it? What is happening to the spread between bid and ask during high-volume moments? Are transactions hitting bids or lifting offers? These questions reveal actual information about market participant behavior. Volume color? It is decoration. Some trading platforms even let you change the color settings entirely. You could make all your volume bars purple if the mood struck you. Would that change anything whatsoever about the underlying market? Of course not, because the color is assigned by software based on arbitrary rules that you can modify with a few clicks. Think carefully about that. The element so many traders base genuine financial decisions on is a customizable display setting. Here is where the mathematics become genuinely uncomfortable. Various studies have examined retail trader performance, and the results are consistent across markets and timeframes. Estimates suggest between 70 and 90% of retail day traders end up net negative over meaningful periods. The reasons for this are complex and numerous, but one pattern emerges repeatedly in the research. Retail traders systematically misinterpret basic chart elements. They see what they want to see. They construct narratives that confirm existing biases. They find patterns that feel meaningful but carry no predictive power. Volume color is a perfect vehicle for this tendency because it is simple, visual, and feels like it should mean something important. Meanwhile, quantitative traders at serious hedge funds are running sophisticated order flow analysis. They examine actual bid and ask imbalances tick by tick. They measure the aggression of market participants by tracking whether transactions are hitting bids or lifting offers. They analyze the size distribution of orders and the timing patterns of large players. This is real information extracted from real data feeds using real expertise developed over years. Green and red bars, those are for the people they trade against. I want to be precise about something here. Volume itself is genuinely useful, extremely useful. High volume can confirm legitimate breakouts. Low volume can expose false moves. Volume patterns over time can reveal accumulation and distribution when analyzed properly. But the color of individual bars? That is noise dressed up as signal. It is a costume that makes randomness look like meaning. And here is the uncomfortable kicker. You probably learned this interpretation from someone who seemed credible, a YouTube trader with hundreds of thousands of followers, a course instructor with impressive sounding results, a book that received enthusiastic reviews from other people who also did not understand the problem. The volume color myth perpetuates precisely because it is easy to teach and easy to learn. It makes genuinely complex market dynamics feel simple and tradable, and simple sells remarkably well. Real understanding is messier. It requires acknowledging uncertainty. It requires studying order flow and market microstructure, and institutional behavior patterns. It requires admitting that the market is not a simple story of buyers versus sellers with convenient color coding. So what do you actually do with this information now that you have it? First, stop making trading decisions based on volume bar color. Simply stop. Remove it from your decision process entirely. Second, if you're serious about understanding what volume actually reveals, investigate real order flow tools. Level 2 data, time and sales, footprint charts. These show actual information about where transactions are occurring relative to the bid and ask. They reveal whether buyers are aggressive or passive. They expose the behavior beneath the surface. Third, zoom out from the obsession with finding perfect indicators. The fixation on chart elements like volume color often stems from a desire to find certainty in an inherently uncertain system. That certainty does not exist. The traders who consistently profit are not the ones who discovered some secret indicator. They are the ones who learned to manage risk and probability without needing to be right about every trade. There is something almost poetic about this whole situation when you step back. Millions of traders worldwide stare at the same charts every single day. They see the same green and red volume bars. They construct the same narratives about buyers and sellers engaged in some epic battle for control. And every single one of them is wrong in exactly the same way. The market does not care about your narrative. It never did. It is simply a price discovery mechanism where transactions occur when buyers and sellers agree on terms. The color of the volume bar is a story you tell yourself, a comforting fiction that makes chaos feel like order. And here's the question I will leave you with. If one of the most basic, most universally accepted, most confidently taught elements of chart reading is fundamentally misunderstood by nearly everyone who uses it, what else on your screen might be a beautiful, convincing, expensive lie?